be careful. Take your beer goggles off right now and listen to this video right now, because smart money is leaving the market right now, and I expect the market to be choppy as we continue to hit record highs in the market. Valuations are reaching levels that historically align with periods of market pullback. Now, I am still very bullish due to AI, but I want to give you some new information that I have here in this video so you can make better choices and decisions going forward for the rest of 2025. Before I jump into the video, I have a webinar. This is the last day to sign up. This webinar, I will be collecting premium selling put options. It will be a recorded webinar. If you cannot join, it will be sent to you. It will be live trading 3 p.m. on September 18th Eastern. Again, it'll be recorded and I will be trading live. I will be selling at least 3 to 5 different put options on different stocks, SoFi being one of them, Palantir, as well as a couple of new stocks that I haven't really covered. I'm going to be talking about strike prices, entry timing, scaling your account, and I'm going to have different ideas. So this is going to be a very interesting masterclass. Again, it's going to be Thursday, September 18th, 3 p.m. Eastern. It will be recorded and there are limited spots, so make sure to join, and if you can't, it'll be sent to you. Now let's discuss what I see going on in the market. Despite soaring valuations, fund managers are still showing confidence, especially in the small and mid caps, right? But thanks to earning strength and domestic growth tailwinds, investors are seeing a lot of opportunity in the market. However, I need to say that smart money is leaving and they are de-risking in pockets of the economy. And what I see happening and what I've noticed is that they are leaving into more defensive stocks. We don't really notice this, but from my conversations with some of the smartest investors, they are going more into defensive stocks. They're looking for opportunities in the market with asymmetrical returns, but with better risk management, with better risk principles, with better valuations, more on the value side, companies that have sold off and are not necessarily at 52-week highs. So look at this. The top 10 stocks now account for 37% of the S&P 500. Okay, 37%. That is absolutely insane. Now, they are also at record highs or just right about record highs. This concentration means weakness in just a few can drag down the broader index and increases the risk in the most popular names, okay? We already know those names. We have Nvidia, we have Tesla, we have Amazon, Google, Microsoft, right? All these stocks right now, they're not really trading at the best levels. Now, Google is trading for better valuations than its peers, but I want to talk about the overall market instead of getting into individual stocks right now. The S&P 500 forward PE ratio is about 21. And in the last 10 years, the average is 17. So right now we have a roughly 24% premium to the last 10 years worth of history. Now, there's also another metric, the Shiller Cape ratio. It is sitting at around 32. And historically, every time it's been above 30, the following 10 years produce below average returns, okay? So I want to talk about smart money versus retail money, and then I'm going to give you the answer of what I would be doing right now in this market. So here's the thing. Equity inflows. Retail investors have added about $15 billion into U.S. equity ETFs in the last month alone, while hedge funds actually cut exposure by 10% over the same period. So there's a misbalance right now. Retail investors are piling in. Okay, that's what you can call dumb money, and I'm a retail investor as well, so don't take offense to it. And hedge funds are cutting exposure, which is the smart money, the money managers, the hedge funds, right? They have cut. So that's very kind of concerning to me. Also, if you look at the put-call ratio, it has slipped to near 0.6, which is now the bullish euphoria zone. Historically, when it falls below 0.7, markets tend to pull back within 1 to 3 months, okay? On the insider selling front, corporate insiders sold roughly $9.5 billion worth of stocks in the last 30 days, which is actually the highest monthly pace since late 2021. Okay, so hedge funds cutting exposure, insiders are selling their stock, right? These are two smart money indicators, okay? Now I want to give you kind of my analysis of what I think is going to happen next, what stocks to be invested in, and where's their opportunity and where's their risk, right? Nvidia, first, it's trading at 35 times forward earnings with semiconductor sector medium at about 19. Now, clearly, Nvidia is the leader. They are leading in the AI infrastructure. I think Nvidia is going to be fine overall. I think that the stock is not necessarily cheap, but the valuation is reasonable for Nvidia. Next is Tesla. Tesla has been on an absolute tear lately, and it's back to over $400 per share. It's up 16% in the last 1 month, and this stock is, again, heading back to some nicer valuations. I think this stock can be a $2 trillion company. Of course, Elon Musk with some of his, more of the political side has hurt Tesla, but now I think some of that is going back behind us, and now Tesla is focused on innovation again. Innovation, execution. So Tesla, I think, is going to do pretty well, and it's also an AI play as well. Now, where I see huge opportunity, okay, 2 ETFs that I see massive opportunity in the sector. The first one is XLV, which is the healthcare ETF. Currently, it trades at 18 times forward earnings, which is actually a 15% discount to the S&P 500, and it's one of the few defensive sectors that is not bid up. So XLV, I actually plan to talk about several of the healthcare stocks on Thursday because I don't have enough healthcare myself. So during my live trading session, I will be purchasing or selling puts on a healthcare company. So that's going to be an interesting thing that you can check out. Now, the next ETF is XLF, which is the financials ETF. Now, banks, they're trading for roughly 1.1 times book value. And historically, it's been 1.7 times, okay? So you can see that investors in the markets are very skeptical in financials. They think there's going to be some weakness. But I really think that we're going to continue to see good, solid earnings coming from the financials. So again, on Thursday, I plan to invest a little bit into financials because I do have a lot of cash available right now. So when I said I'm going to put $3,000 in premium collected, more likely it's going to be a lot more than that. But it's going to be $3,000 minimum in what I collect. That's what I'm going to be doing. So look, I've talked about some of the bad in the economy and what to be concerned about, but let's also talk about why this time is different in the bull case scenario, right? Because obviously markets are not stupid. We're high for a good reason, and that's because a lot of investors are bullish, and that is because of the AI productivity boom. So unlike the dot-com bubble where most companies had no revenues, people were just like, oh, the internet's going to be big. And they were right, the internet is going to be big, but a lot of those companies did end up failing. But today it's a little different because the companies that are bid up very high are obvious plays, such as Nvidia, Microsoft, Amazon, and they are generating massive cash flows. And it is obvious that AI is going to be, it already is very, very important to our economy. So AI is cutting costs, accelerating innovation, and boosting earnings. So it's not just hype. AI is here to stay, and it's going to only continue to grow. And that's why Nvidia, if you look at it, it's very high, but Nvidia's revenue is up 250% year over year. So it's unprecedented to see this type of growth in mega cap history. So we are sustained in the rally. We have sustained revenue generation from the biggest companies. Also, if you look at corporate balance sheets, they are strong. So U.S. companies hold $4 trillion in cash, giving them firepower for buybacks, dividends, and reinvestment. And as these companies buy back their shares, it does make the shares more valuable, right, per share. Right, so also a lot of share prices are going up for that reason. Now, in terms of earnings strength, 80% of the S&P 500 companies beat earnings expectations last quarter. So we are in a bull run, and despite smart money leaving, I believe they are just taking profit, and they just want to get some chips off the table, which I don't blame them. And you have to understand that a lot of investors want to de-risk, especially when markets continue to go high, because there are more skeptics. Okay, more people are going to be skeptical when the market is high, because just historically, the higher it goes, the lower the future returns can be. It's obviously better to kind of get in a little bit lower if possible. But again, it depends because the whole market is bullish on a long-term basis forever. It's been bullish every 10 to 15 year period for sure. You've never lost money. So, just normal taking profits, in my opinion, for the most part. But look, the Magnificent Seven are expensive. The other 493 stocks in the S&P 500 are trading near historical averages. So it's really just the Magnificent Seven really pulling up the entire market. And the gap creates one of the best setups in years for really selective investors who know where to look. So again, if you know where to look, you know what stocks to buy, and you actually do the research, then stocks are really at historical averages. So the market's looking very good besides the top 7, which are a little bit over leveraged. And any pullback will significantly pull back everyone's portfolios. So there's really a split in the market where smart money is rotating. Smart money is looking for opportunities to get out of some of the Mag 7 stocks and into some other stocks that have some hidden value. So that's what I'm going to be doing this week. I'm going to be researching more stocks to buy. So yeah, if you're interested in looking at more of those stocks that I believe out of those 493 stocks, not the Mag 7 stocks, which are good opportunities to get in on a long-term basis, then join me on Thursday to not only watch me, make $3,000 in collected premium, but also go over some new names, some boring names that are unpopular with the algorithm that I'm not going to be able to cover on YouTube. They're just too boring and YouTube will penalize me if I talk about stocks that are just not that interesting. They're boring, but they're money makers. Like Walmart. Like I made $300,000 on Walmart, but I can't really even make a video on it because nobody's going to be interested in clicking on a video on Walmart. So unfortunately, I am a little bit, pinned to the YouTube algorithm, and that's why I want to do a webinar. Is I really want to get attention for an entire, 45 minutes to an hour to really break down and create a game plan for the next 6 months to 12 months. So it's going to be one of the best experiences for learning how to sell puts as well as planning the next 6 to 12 months. And we'll be looking at a lot of interesting stocks. So join me on Thursday, and I'll catch you in the next video tomorrow.